The Genius Act recently passed by the United States is all set to change our lives. Until now, only governments issued currencies. Now the Genius Act allows non-government entities like banks and even non-banks like an Amazon to issue currencies called payment stable coins. Now, what are payment stable coins? They are midway between currencies like dollar and cryptocurrencies like Bitcoin. Stable coins are defined by the Genius Act as any digital token that is recorded on a cryptographically secured distributed ledger. The Genius Act establishes a regulatory framework for payment stable coins. Who can issue payment stable coins? All banks and insured depository institutions like credit unions in the US can issue payment coins. Now, for an explanation, an insured depository institution is one that takes deposits from savers and gets insurance protection from the FDIC. Non-bank entities can also seek a license to issue payment stable coins. All companies that want a stable coin issuing license have to go to one of the following three regulators. One, large banks regulated by the Federal Reserve have to go to the Fed for such a license. Smaller banks or credit unions that want to issue less than $10 billion of stable coins may seek a license from the state banking regulators. Non-banks like, say, a Walmart or Amazon or even Tether and Circle have to go to the OCC or the Office of the Controller of Currency for a license to issue payment stable coins. Now, payment stable coins aren't going to come very soon, okay? The Federal Reserve, the FDIC, the Treasury Secretary, and each state payment stablecoin regulator will have to issue implementing regulations after seeking comments from the public. The Act says that these rules have to be made within 1 year of the enactment of the Genius Act. The regulators have to make rules regarding capital requirements, liquidity standards, reserve asset diversification standards, interest rate risk management standards, and standards related to operational, compliance, information technology risk management, etc. The Genius Act takes effect 18 months after the enactment of the law or 120 days after the primary federal stablecoin regulators have issued their final implementation regulations. Since the Genius Act was signed into law by President Trump on July 18th, 2025, one may expect these stablecoins to become effective payment instruments by around January 2027. Though it is not common for regulators to take longer to frame the rules. For instance, the Dodd-Frank Act was passed in July 2010, but regulators made rules only by 2013. Some part of that act were implemented only by 2015. So it may well take more than 2 years for payments through stablecoins to take effect. There is an additional hurdle. For companies like Walmart or Tether, the rule is no non-bank can issue payment stablecoins unless it obtains a unanimous vote from the Stablecoin Certification Review Committee. This committee is made up of the Treasury Secretary, the Chairman of the Federal Reserve, and the Chairman of the FDIC. And it is possible that these eminent regulators won't give licenses very easily unless they are convinced of the robustness of the companies that are applying for such licenses. While the detailed rules are still to be made, the Genius Act sets out some basic rules. Issuers have to back every coin that they issue with equivalent cash or US Treasuries. Also, issuers have to comply with anti-money laundering laws, and they have to report suspicious activity. They have also to report every month the composition of their reserve portfolio on their website, which means make it public. These monthly reports must be examined by a registered public accounting firm, an auditor. And the CEO and the CFO of the payment stablecoin issuer must certify the accuracy of these reports to the regulators. The primary use of these payment stable coins could be for retailers. You know, retailers like Amazon.com or Walmart, who have announced their intent to issue stable coins. They expect to save millions in terms of fees, you know, merchant discount charges to banks and card companies. It also ensures instantaneous payments like India's own UPI across suppliers and buyers. You know, another ready use case for stable coins is international transfers. Today, sending a $100 remittance from the US can cost like 6% in terms of fees, and it can take days to clear. Compliant stablecoins can cut that cost to just pennies and the time taken to just seconds. The US government might be another beneficiary of the Genius Act. Some estimates say that mandatory Treasury bill backing means stablecoin companies could become top buyers of US treasuries. Who are the losers? Visa and MasterCard shares have been slipping amid fears that, on-chain dollars could steal settlement volumes from these card companies. Banks may also lose some income from retailers. Also, they may lose the idle float if companies start paying, say, part of their salaries via stablecoins. But despite a long history of auditing and regulation, banks have failed. So, stablecoin issuers have a far more light touch regulation. If these companies cheat on the rules, if they issue more coins than they keep reserves in the form of dollars, they can collapse. Remember, the Silicon Valley Bank failed because the value of the underlying treasuries fell. This can happen yet again, and it can set off a chain reaction of defaults. Experts doubt if regulators can keep track of so many more uninsured issuers of currency like tech firms and crypto startups. So those are the fears generated by the Genius Act. Well, that's the preface. I now have with me two economists, Professor Barry Eichengreen and Professor Ishwar Prasad, who are experts in the field of both money and currencies and have worked on cryptocurrencies. First, let me invite Professor Barry Eichengreen, who recently published a very critical piece in the New York Times saying that the Genius Act will bring economic chaos. So, with that, let me welcome you, Professor Eichengreen. Thank you very much for your time. First up, the detailed rules as to who will issue the stable coins, what will be the capital and reserve requirements, are yet to be written by the Fed and the FDIC. Now, if these organizations make the rules very strict, can that chaos be avoided? You don't think that's possible?
I do not. So we have to see what the regulations will look like. So the Genius Act permits the FDIC and the Fed and the other regulators to promulgate rules for stablecoin issuers, but it'll be 18 months until we see the rules. And there is plenty of historical evidence suggesting that issuers can get around rules. They can bend them, and I worry about their ability to stay one step ahead of the regulators.
Okay. You say 18 months. Who all have to write rules? Is it the FIDC? Which are the regulators?
It is the comptroller of the currency and the U.S. Treasury. I think that will be in the lead in writing these regulations, and the Genius Act gives them a window of time.
Okay. Is there any advantage at all that you see in stable coins that is not being, achieved by the sovereign US dollar?
Well, it depends who you are. If you're a resident of India, you already have UPI. Yes. So you can make instant payments at low cost between bank accounts, and having a new set of payment rails doesn't do much for you domestically. Dollar stablecoins may be an advantage in doing cross-border payments, however. So that's the one place where people in India may feel a difference, although UPI is being linked with the comparable system in Singapore and elsewhere. So there are other ways besides stablecoins of doing the same thing.
Okay. Well, I will come to the cross-border transactions in just a minute. Why are you fearing that there can be chaos because of the issue of these private coins?
Well, there will be many different private coins and no guarantee that they will trade one-to-one for one another or that they will be interoperable. So there will be Amazon coin and Walmart coin. Can you use Amazon coin at Walmart or Walmart coin at Amazon? Will there be an exchange where you can trade one for the other? We don't know. So there could be many different tokens trading at many different prices, putting at risk what economists refer to as the singleness of money, where every dollar is worth a dollar and can be used everywhere, or every rupee is worth a rupee and can be used everywhere.
Well, the rules appear to suggest that for every dollar issued, there should be US Treasuries backing, and that there will also be capital prescribed for the issuers themselves, so that if there is a hit, it is the shareholders' capital that is first taking the hit. You don't think these are safeguards enough?
No, I don't, because I think we've seen plenty of counterexamples where existing stablecoins have been backed not only by Treasury bills, but by bank deposits at places like Silicon Valley Bank, where they turned out not to be so safe after all. And the stablecoin in question went to a discount. We've seen money market mutual funds in the United States that broke the buck where a dollar share fell below a dollar because supposedly safe bonds turned out not to be safe. I think we need to worry about that more generally in the Genius Act context.
Okay. Okay. Yes, there is a possibility that, the face value of the bonds fall because of a rise in interest rates and the company is incurring losses and there is a panic withdrawal. But in the case of, let me try my best to see if there is any advantage at all. Do you think that the stable coin will, help the issuer earn money, make a profit because they are backed by treasuries? And on the other hand, will it make it very easy for the United States to fund its debt, to finance its debt?
If stablecoin circulation grows the way people like Treasury Secretary Scott Bessent anticipate, so there might be $2 trillion worth of stablecoins outstanding, backed by $2 trillion of Treasury bonds and bills by 2028 or so. That would create additional demand for US Treasuries and therefore strengthen the dollar. But it's also a volatile form of demand where there could be run-on stablecoins. That backing would have to be liquidated all at once, and that could crash the Treasury market. So I would say in this context, be careful what you hope for.
Okay. Well, and from the issuer's point of view, the only profit they make is the yield on the treasuries. That's the only way they have to fund the whole thing?
That's basically how they fund the thing, exactly. They take my dollars and your rupee, and they issue you a token. They invest them in treasuries, and they earn some interest on that. They give us, you and me, payment services. The idea being that payments will be faster and cheaper than they will be using credit cards, bank accounts, or UPI, to which I would ask how much cheaper and faster.
Okay. Well, let me look at it from an India point of view. Would a country like India or Indonesia or Philippines, any other sovereign country, be afraid of stable coins? I mean, why would an Indian government want to lose control over the rupee or even the amount of rupees that are transacted into dollars? They may want to retain that sovereignty. Do you think that sovereignty will be challenged, their ability to make monetary policy?
I do think it will be. 99.5% of stablecoin circulation at the moment is in US dollars. So if they begin to circulate in India, that is the equivalent of dollarization, where people are shifting out of rupee into dollars for their payments and transactions. And that leaves the Reserve Bank of India with less leverage over the economy. It's called currency substitution, and it is a problem for central banks.
But can't governments, other governments, legislate it out, render it illegal to do domestic transactions in dollars?
They can try. Okay. That's what domestic financial regulation is for, but a lot of questionable things go on in the crypto sphere. Every time governments try to outlaw crypto transactions, crypto users tend to find a way around those restrictions. So it will be a race, if you will, between the greyhounds, the investors, and the bloodhounds, the regulators.
Oh, yes. In fact, according to Chain Analysis, that the firm that looks at these data, India has, I believe, the largest number of cryptocurrency users. They estimate almost 95 to 100 million crypto users in India. Do you think we are particularly exposed to this probability of, some private transactions happening outside the realm of the Reserve Bank, that is, through stablecoins?
I actually think India is in pretty good shape from this point of view because it has UPI. It has a digital system that's universal, that is fast and cheap, and that potentially can be used cross-border as well. Very few other countries have moved as far down that road. So there clearly are risks for India given rapid adoption, but given the provision of alternatives by the banks and the RBI, I think that is a bit reassuring.
Yes, it's certainly reassuring that we have a very fast and efficient method of payment, digital payment. But it is not always the desire to quickly pay that attracts people to stablecoins and cryptocurrencies. What I fear is that stablecoin now makes it very easy to use legitimate currency, the sovereign issued currency, to buy crypto assets. Is there a possibility that people who want to do illegal fund transfers use the stablecoin, get into the cryptocurrency route, and then do these fund transfers internationally?
There is a very real danger there. The main use for stablecoins at the moment is as on-ramps and off-ramps for other cryptocurrencies. You move your rupee into a stablecoin, and then when the time is right, you buy Bitcoin or some other plain vanilla crypto. And when you want to get out, you get out similarly via a stablecoin. So this is kind of an enabler of use of other cryptos. And we know that other cryptos are used for all kinds of illicit as well as licit transactions.
Wouldn't that also impact the United States? The United States should be equally worried about transactions happening outside the realm of the law, basically outlawed transactions. Would that lead to some kind of breaks on the system? How do you see the US tackling illegal transactions?
Well, the Genius Act says that stablecoin issuers have to demonstrate the capacity to follow and enforce know your customer and anti-money laundering rules, and there will be an accompanying act affecting other cryptocurrencies likewise that will mandate that they follow such rules. But whether mandates will be enforced in practice and whether we can be sure that what is written on paper will happen in the real world, sounds like you and I share doubts.
Yes, we do. You said that you expect the laws and the rules to be in place in 18 months, and then we will start seeing stablecoins as, stablecoins kind of taking on. Do you expect that these rules can be written very strictly and, no space is allowed for illegal transactions? They may take longer. They may allow only fewer people to issue coins, but they make it safe. Is that a possibility?
I think the really bright people in the crypto sphere are working for the private sector and not so much for the government. So I worry about the private actors being one step out ahead of the regulators. In principle, technology can help here. We can place on top of stablecoins programs called smart contracts that will automatically use computer code to enforce know your customer and anti-money laundering rules. But those kind of contracts can also be used to evade regulations. So I am deeply worried about how this is going to play out.
Okay. Do you expect, now you're saying it's 18 months from now. Let's assume it's even 2 years that the rules take on. Is it possible that a subsequent administration waters it down? I mean, I'm just trying to look at ways in which this doesn't become so chaotic.
Yeah, so we've seen that kind of regulatory pendulum swing back and forth throughout history. So there could be a clampdown. Unfortunately, a clampdown typically occurs after something goes wrong. So we had the global financial crisis in 2008, and then the Dodd-Frank tightening of regulations in the US in 2010. It would be some kind of run on stablecoins, some kind of panic that would precipitate, I think, a regulatory reaction. So there would first be a cost, and then there would be a response.